And so I'm used to talking to people, but this is a whole new thing. Having a mic with no sound, it's weird. Anyway, so I'm an actor, and I came to Artbooks, where I now work, right after I finished theater school, because all my friends would talk about write-offs that have receipts. You can write off your CD collection, all that stuff. And I was like, what is this magic of write-offs? And why would I give the government money if I don't have to? So I went to Artbooks as a client in 1997. And really with the sole nerdy desire to keep my money. Maybe that's not nerdy, but I wanted to keep my money. I didn't want to give it to the government. And after a few years of watching my now boss work her magic with saving me money, I got really interested in getting better at it to the point where people wanted me to help them with their bookkeeping. And now I've been working at Artbooks for 12 years as a tax preparer. I'm a senior tax preparer there. I do a lot of the training and coaching of the new tax preparers, and our office is very specifically designed for art, and our tax preparers tend to be artists because they speak the language of their clients. So we have a lot of musicians on staff, we have a lot of writers on staff, visual artists, graphic designers. We have a lot of neat art people who can come in and you can speak their language. So I talked to Matthew a little bit about the demographic today, and I understand that this is mostly like classical music and composing. Is that correct generally? Yeah, and film music, so scores. Yeah. Cool. Okay, and all men, which is like a first, I think. Abigail is not you're like not quite an attendee. I don't know. Anyway, we've got a lot of men here, which is weird.
I'm a composer.
And well, yes, of course, and a teacher. So. That's a bit about my background. I've been doing bookkeeping for about 20 years and tax for about 12 years, and do these tax talks to whatever organization would like me to. So I go to Ryerson and talk to the photography students. I go to Sheridan and talk to their theater students, visual artists, that kind of stuff. And I try to gear my talks towards your industry, but if you feel like I'm going away from what you need to know, don't be afraid to pipe up and say, what about X? If we don't catch it on the mic, I can always repeat it if I have to. But from what I understood from Matthew, we're going to be talking, I hear there's a lot of grant applications that happen in this industry. Do we have a lot of people that are applying for grants? Yeah, generally, half of us are doing grants. What else is going on here that people want to hear about, just so I can log it in my brain?
I just want to go to HST collection.
HST collection. I'm quick on the draw here. So HST collection, got it. And working internationally. Okay. When I do questions for real, we'll go slower. But just working internationally, HST is going to get hit, and international work. So we can talk about all that stuff. So I think the first basic question a lot of people don't seem to know is when your tax filing deadline is. Does everyone know when your tax filing deadline is? No, but nobody. March 31st? Anybody else have a guess? Abigail.
Yeah, April 30th, except for self-employed income, it would be in June, right? Is it June 15th?
June 15th,
But if you owe money, you have to pay it by April 30th.
She can teach the course. Correct. Done.
Lots of questions.
Yeah. So everybody in Canada has a deadline of April 30th, but if you have a freelance business, you have an extra 6 weeks to tabulate your receipts, which is the nice gift of the Canada Revenue Agency. I'm going to call them the CRA. It's easier than saying Canada Revenue Agency, but that's our tax collecting body. So I'll be doing CRA as a short form. They give us extra 6 weeks to do all of our little receipts, add up our math. But if we owe, we have to pay by April 30th. So if you're going to file by June 15th, that's not a problem. There are no penalties for filing that late when you have freelance income. But if you think you owe money, you can always just send them a guess by April 30th. You can say like, well, last year I owed $5,000. I don't have time to do it before April 30th. I'll give them $5,000. They'll hold it for you. And then when you file your taxes, if you've overpaid, they give you back what you've overpaid. If you've underpaid, you pay the difference, but you're paying the difference with much less interest. So the way that the CRA can get to you, and this is what I see the most, is interest and penalties. The penalties come when you file late. So June 15th is our deadline. If it's a weekend, you get the extra day, so June 17th sometimes, if there's an extra couple of days there. But if you file after that date, it's a 5% compounding interest for every day that you're late. And if you're late continually, they amp up that penalty. So if you're late repeatedly, 3-4 times in a row, it can go up to 17% penalty. So it can really, really be punitive. the filing late penalty. So your main gift to yourself, whether you have money or not, is to file on time, because you save a huge amount of penalties. Interest is on paying late, and that's only 1%. So you can pay late and, owe $100 at the end of the year on your payments. It's not the same as that compounding 5%, which every time you're late, they up. So 5% one year, 6% the next year, 7% the next year. Don't ever, if you can avoid it, don't file late. That's sort of the main gift that I'm seeing. A lot of clients that come in, I work and do taxes all year round. People think, well, aren't you quiet in December? I have more requests in December than I have in June. People don't want to do their taxes for whatever reason. There's a lot of emotions around money. There's a lot of fear around money. There's a lot of April is a bad month because your mother died or something like that. So you sort of avoid April and you don't do your taxes. So people are filing taxes late all the time. And the penalties are what get them. They owe $4,000. By the time they file, they owe $5,000 because penalties and interest add up. And they had 4, they didn't have 5, so now they're in debt again. So your best gift to yourself is to file on time, to know your deadline, which is June 15th. And if you think you owe, just give them a guess by April 30th. It doesn't have to be the exact amount that you might owe, but just give them some money. Same thing goes with HST. You have until June 15th usually to file, depending on your corporate structure. Send them some money. Let them hold the money for you. I think that they are trained to think that we are flight risks when we owe more than $3,000 a year. So the $3,000 a year limit for both tax and HST, they want you to start to pay in advance, because $3,000 is where they feel like people start to freak out and stop paying. So you will start to get requests for installments when you owe more than $3,000 a year. So instead of letting them come to you and say, you should be giving us this, just send them money. I have one client who gets a check. Every time he gets a check, he just sends them money. So it can be twice a week. He can be like, here's $13, here's $26. He will just send them the money. At the end of the year, he gets a huge refund because he's given them every single penny he's received. And then at the end of the year, he gets a nice refund. He gets to go on a vacation. So finding a way to manage your cash flow is really, really helpful. For me, what I do is I take a third of my income every time I get a check, I stick it in a tax-free savings account, and then once every quarter, I just give it to the government. So that every quarter, I make that account go to zero, I give them the HST, I give them the tax, that account goes to zero, and then I've given them basically everything that I think I'm gonna owe, so that at the end of the year, if I owe them $10, it's okay, I can handle the $10. But when I'm owing them more than $3,000 a year, they want it in advance. I find paying tax really easy. You can pay tax by doing an online bill pay the same way you would do your phone bill or your property tax bill. You can pay your tax really easily, but with HST, it's harder to pay. They want you to have a business bank account. I don't know why. So you can also just pay the HST by going to the bank with a remittance voucher. So just bear in mind, paying your taxes, do it by April 30th. Do whatever you can to file on time, and you'll be saving yourself a huge amount of money. So those are the things that I've witnessed now after 12 years of tax. People struggle is when they file late. The penalties really, really crush them. So if you can avoid doing that, you're in good shape. Another thing to remember is that if you have a partner, married common law, and they are a non-freelancer, they can still file with you until the deadline of June 15th because they are married to a freelancer. So if your partner is a non-freelancer, they're still allowed to file till June 15th as part of the package deal of being married to you. So. Married and common law. If you are filing as a common law or married partner, your partner, whether they have a day job or not, can file with you until June 15th. Because we really do try to do our couples together. When there's credits that can go back and forth between a couple, or there's kids, childcare, that kind of stuff, have you guys file together is really, really helpful. So everything we can do to encourage couples to file at the same time, including extending the deadline for non-freelancers, is really, really helpful. Okay. Is everyone here filing a freelance tax return? Yes, no, yes, maybe, yes. So people here are familiar with keeping track of their books, their receipts, their record keeping. You guys are all so quiet. I know it's a miserable day out. But, oh, there's another person coming in. Is there another person coming in? I don't know. Maybe. So, does anybody here use any online bookkeeping software? Is anyone familiar with, there's kind of, sort of? What do you use?
I have a credit card that I only use I have a credit card that I strictly use for spending with regards to my business.
Yeah.
And that credit card is attached to FreshBooks.
Oh.
So every time that I have to do taxes, I just export a CSV doc of the spending from that credit card, and that is spending from the business.
That's a really nice idea. Does anyone else ever used anything like a FreshBooks or a QuickBooks or a Wave accounting? They keep on saying that most of our jobs are going to become obsolete because computers are going to do it. And I'm always like, no, taxes are always going to be around. But I start to see that there's a potential for my job to go away because the bookkeeping softwares available are quite good, quite sophisticated. And most of them are quite cheap if they're not free, $20 a month or so. FreshBooks is really good for invoicing.
I use it for that.
Yeah.
For bookkeeping, but bookkeeping has become sort of a side product, a side effect of what it can do.
Bookkeeping is becoming a side effect of the FreshBooks. FreshBooks is great for invoicing. So, for instance, my therapist uses FreshBooks to invoice me. That's her job. I find FreshBooks really great for that. So, does anybody here invoice clients? How do you all? Yes. What's your name? Felipe. Felipe invoices his clients and nobody else does. Yes. And what's your name? Rob. Okay. Rob. Well, Rob, do you want to chat? Yeah.
So for invoicing, I use FreshBooks, same as Felipe was just saying. I don't use it for the bookkeeping side of things either, but I scan receipts into my computer with Neat Scanner.
Okay.
It's just a scanner, basically.
Okay.
And then I go through them when the time comes at the end of the year, basically.
Yeah, I mean, that's how most people do it. I have the same thing. I use a paper bag on my desk to keep my receipts. As a professional bookkeeper, I hate doing my own bookkeeping. So for me, my technique, which is going to be the same as any of my clients, is I have a paper bag on my desk. I use a paper bag because it stays open, so it's easily able to receive the crap that I'm throwing in. Find something that you find easy to use to keep your receipts. Receipts are your best friend. They are the reason that you will pay less tax. So you want to ask for receipts everywhere you go, all the time. It doesn't matter which country you're in, ask for a receipt. It is the reason you will pay less tax. I say to my clients all the time, I'd rather you give me too much, and I say that's plenty, than for me to say to them, which I say often, go home and look for more receipts, because people judge their expenses, they judge their lifestyle, they judge their money, there's so much judgment involved in this stuff. Don't judge your money, don't judge your receipts, save your receipts, add them up, there's no judgment around them, bring them to your accountant. Yes, Felipe. Felipe. Yes.
And I hope I haven't been making a huge blunder, but I used to do scanning of the receipts until it just became a huge hassle.
It is
And
a
I
hassle.
stopped, and I tracked everything via what I just said, via just like, okay, it's on the credit card record, and it's on the CSV, fine, that's where it is, and I'm getting rid of the receipt, it's there. If I were to get audited, would I still need to have the receipts?
It's a really good question. I get asked this question a lot because receipts fade and they get a little invisible, but they want receipts.
Okay,
Unfortunately, you keep your receipts for 7 years. You just have to. My sister is going through a 3-year audit right now, and it has been the nerdy tax person in me is really fascinated watching it all go down. The part of me that's really sad for her is is sad, but the part of me that gets to go to the CRA and talk to her auditor and look and see what he wants it's been really interesting. They want receipts. We had a meeting last week, and she lost 2 years of receipts there was a big flood in Toronto 2 summers ago where the water rose on King Street and people were like drowning in their cars. You remember that flood? It was a big flood. Anyway, that happened 2 years ago. Her buildings, sewers, pipes burst and destroyed her storage locker. She lost 2 years of receipts. So they are currently under audit those 2 years. She has no records, but the auditor made her show the video that they took of her husband holding up all of their receipts soaked in water with the water pouring in. So yes.
We have a comment from online from Daniel. I tried using Wave, however, ended up going back to pen and paper. Wave and Square are good for invoicing.
That's true. Wave and Square are good for invoicing. I don't love Wave for receipt keeping. I like things like QuickBooks, which I think is a bit of a better bookkeeping software. You have to find the thing that works for you for bookkeeping. And if Wave doesn't work for you, it's good for invoicing, great. But for bookkeeping, because that's the part where you're saving the money, that's the part you got to make fun for you. I use Excel. When I was starting out, I used Excel. Excel is really easy. Scanning your receipts, if you don't mind doing it, is a great thing to do, because then you have a photograph of it. But as I said, the auditor wanted receipts. My sister's receipts were destroyed in water, and we played a video to the auditor showing the receipts being destroyed by water, and that was the only way he was going to accept the fact that she'd lost 2 years. So I know it's kind of annoying, but I have a storage locker full of receipts myself. They're not in bins. They should be because of the flood potential. But keep your receipts. Keep all of them. There are ones that are going to be electronic, your Amazon receipts, all the electronic stuff. Just put a file on your desktop with the electronic receipts. You don't have to print them out, but have them in case you require them. Keep your receipts. So for most people, the matter of bookkeeping is literally just going through, sorting by category, which we'll talk about, and then adding them up. So you can use an adding machine with a tape. You can use QuickBooks, which I like because you're just plugging in numbers. You hit a button and the math is done for you. Or you can use something like QuickBooks. Yes, Abigail, online.
This is from Luis. A question: is there any criteria for an audit, or is it completely random?
It's a really good question. I asked my sister's auditor why she got audited, and he said, I don't know, it's an algorithm. It really is fairly random. She had 1 year out of the 3 she's being audited for where there was a really big spike in advertising, which was due to the fact that her really crappy bookkeeper misentered an expense that was $600 as $68,000. She's now being audited. So it can be anomalies. Also, something to remember is that audits are very different than reviews, and pretty much everybody in this room is going to have a review from the CRA, and it's not the same as an audit. Reviews are basically a make-work project in the fall for the CRA staff who have nothing to do because they're busy in April, and then in September they're like, well, there's nothing to do, no one's filing their taxes. So they have make-work projects, which are also part of our integrity check system, because we tell the government this is what it is, and the government's like, okay, now prove it. So they'll review things like your medical expenses. They used to review Metro passes. They'll review your rent expense because there are credits we get for paying rent. So they can send you a letter saying this is a review, and it is just a review. It's not an audit. You will know when you're getting an audit. It'll say this is an audit. Yes.
Yeah, along the lines of review, this year it seems, well, I spoke with somebody at the matching department.
Yeah, the matching department.
Yes, and I am always called because I submit self-employed tax return, obviously. And, of course I have income slips that don't match because I'm not able to input them specifically because they're going into self-employed income. And so it seems that this year everybody who got an Ontario Arts Council grant was then asked by the matching department to prove where they put that income.
Correct.
And had to then fill out a form saying what they used the grant for, that kind of thing. So can you talk to that a little bit?
Absolutely. There are handouts for the lady who just walked in. If you want a handout, there's some handouts there. So one of the hardest things for freelance artists to deal with is grants. Grants come on a slip called a T4A. Does everyone know what a T4A is versus a T4? Has anyone got a T4 or a T4A? T4A from university. Anybody else have a concept of what a T4A is? No. Okay. So a T4 just means you have a day job. So T4 is you get it. You've probably been paid weekly. They've withheld CPP, EI, tax. They're treating you as an employee. You have no expenses to claim against that because your boss is claiming the expenses and you're one of them. They're paying you. You have a day job. So for me as an actor, used to be working in restaurants. I had a day job. I got T4s for my restaurant job. A T4A can be a lot of different things. It can be scholarship income, it can be grant income, it can be an honorarium, it can be a fee for service. T4As have a broad scope, but for most people who are in this world, T4As are grants. Mostly it's grants, and because the CRA, if we think about our population, all we know is artists, and so our population of artists seems like there's a lot of us. In the greater scope of Canada, there's not a lot of artists, so T4As are mostly deemed scholarship income. The CRA thinks of them as scholarship income because there's more students getting scholarships than there are artists getting grants. So when they see that someone has a T4A on their file, and it's not reported as scholarship income, they say, well, this person, there's no proof that they went to school. There's no proof that they claim this income. Let's follow up with that. So that's where these letters come from the T1 matching program. So this when someone makes a slip, a T-slip, they're required to send a copy to you and a copy to the CRA. So the CRA knows when you're making money that's on a slip because they have a copy. They're waiting for you to file and agree with their records. So think about it as like a jigsaw puzzle. They have one end of the puzzle. You're putting the other end of the puzzle together and saying, you know I have this money. I know I have this money. Let's agree I have this money. That's basically what taxes are for a lot of us. It's the slips. We tell them that we have it. They say, we know you have it. Now give us some tax. With grants, you can put that income in so many different parts of the tax return. It can go in scholarship income. It can go in other income, which is not related to business or a day job. It can go into your business. It can go into pensions. There's a lot of places for it to go. So when we do taxes for artists, we like to put the grant income on your business statement. A business statement, we're going to talk about that in greater detail, but that's your income statement, your profit and loss statement. It's where your business income goes. And grants, for most people, they've applied for them as part of their professional practice. And so at Artbooks, we believe that that's part of your business, and it can go against your business income, and then you can claim expenses against your art practice. So if you got a grant and it was to do a recording and you needed to pay musicians out of that grant, you show the full grant income on your income statement, then you would claim the expenses of the musicians or the recording fees or whatever. We'll talk about that later. And you would claim, and then you would pay tax on what's left. For most people, grants are spent entirely, so you're not really spending money on paying tax on grants, but grants are taxable income. So you have to bear that in mind. People go, I got a grant and I spent it all, so throw this slip out. You got to report it. You got to show you made it. The CRA will send a letter. And we are, as art administrators, basically, we are struggling with the CRA to recognize that grants should go there because the CRA requires that the granting bodies put that income in a box on your slip. It doesn't say it's business income. They put it in a box that says this is a tuition, this is a scholarship, and it doesn't. And then that's what creates a disconnect between the CRA and us. So ideally, if you have a chance, I wrote a white paper on how to report grants. It's on a site called Generator Toronto. I should know. I sent it to Matthew. I think he has a copy of it. But I wrote a whole document on how to report grants. If you don't have a decent arts administrative tax preparer, and you do get grants, it's important to know how to help yourself deal with grants. The CRA isn't looking for them where we put them. They're looking for them as a scholarship income, and it doesn't do anybody any good to have it as scholarship income. We have handouts if you'd like, sir. Yeah, sure. So you will get a T1 matching request fairly regularly in the fall. Felipe has a question. Do you want to give him the microphone?
So I think you touched on something fairly important. The distinction between T4A and T4, where you were mentioning that you had a side gig, let's say,
yeah.
right? You would still file your taxes as a freelancer, even though you have your day job, correct?
Yeah, okay. Absolutely.
Now, the question comes now when it comes to work for hire, which a lot of composers do. Work for hire does not necessitate the client to submit you with a T4, correct? Because that would be that you're employed.
Correct. Most art practice, you're treated as a freelancer.
What if this client is trying to like pass you a T4 for a paid gig?
Are they withholding tax and CPP and EI?
I have no idea.
Well, if they've withheld tax and CPP and EI, then you are an employee. That's what they do. Most people don't want to. So when an employer hires you, they're committing to contributing to your Canada pension and to your EI, as well as any other benefits. So when you become an employee, you cost more money to a hirer. So most people don't want to make you an employee because you cost more money. You cost more money in CPP and EI, so they might want to give you a T4A. And a T4A is okay, because the T4A is for freelance income. Do you know if they're giving you a T4?
No, it just sounds like I just need to talk to this employer, because it sounds like they want to make me an employee, which is not the case.
Okay, yeah, just straighten it out with them. Straighten it out with them. Being an employee isn't the worst thing in the world. You can still have an art practice and be an employee. Like I said, with me as an actor, I worked in a restaurant. I worked as an actor.
No, of course,
yeah.
But with no contract signed and just a work for hire agreement, it's like, okay, why are you giving me this?
We don't know how bookkeepers are working or what their deal is with their funding bodies or their whatever. So just check in with them and see what they want to do. You shouldn't have to be an employee. I don't know. But I don't know. Yeah. So basically, when it comes to the T4A income, scholarship income, grant income, freelance income, it all goes into the same pot, which is it's called the T2125, which is the government's version of an income statement or a profit and loss statement. So if you watch TV and they talk about business documents, the profit and loss statement is the most common one. It's my money, my expenses, I pay tax on the difference. So if I made $100,000 and I spent $90,000, I pay tax on $10,000. That's how taxes work. So when you're doing your taxes, there's 30 lines of places where you can put varying kinds of income: tip income, business income, day job income, royalty income, blah, 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 blah. Ours is just, we report the net income. We show the gross income, which is where all of my money is. I take the expenses out. We report and we pay tax on the net income, which is where your expenses are really, really, really helpful. Because we are a room of musicians, remember that royalties, for most people, are considered business income. The CRA can get confused and they can send, got a lot of letters in the last month from SOCAN, from the T1 matching department asking where your SOCAN income is. Do any of you get SOCAN royalties? So like you get a T5 from SOCAN for $400. I put that on my income statement because it is, to me, if I'm working as an artist and I get royalties from my work as an artist, it goes in my artist income. You can go other places. The CRA tends to look for it as investment income because the T5 reports investment income as well as royalty income. And royalties can be from investments or inventions, rather. T5 can be invention royalty income. You invent something. You could say you're inventing music and that's what that royalty is for. But we put our T5s, our SOCAN, and other royalty income onto the business statement because, to me, it's part of your art practice. Does that make sense? Yes, Rob. Rob needs the mic.
I do have a question about this. You said you might get to it later, so maybe I'm jumping ahead and
Yeah.
you can push it later if you want. But related to HST,
Yeah.
meeting the threshold when you have to begin charging.
I do that whole thing on HST. It's sort of like the gravy at the end of the thing. So
I was just going to say one comment, which is how you were just saying where to report the royalties. I've been putting it in the other category due to the fact that not hitting that threshold. Does that make sense?
that's a strategy.
Okay.
It's a strategy. If you're worried about hitting 30 and you don't want to get an HST number, you can put it into other. Do you do your own taxes?
For up to a certain time. Yes, I have.
Yeah.
My dad and myself have been doing it.
There are strategies. Obviously, with tax, people always talk about tax strategies, and there are ways if we're trying to avoid hitting a certain threshold where we don't have to report our royalty income. We don't have to force it into the income statement because that's not really where the CRA expects it to go. So you can put it, if you were to use a TurboTax or a U-File, which is what the sort of the free or the cheap software are to file your own taxes. If you said I have a T5, they're going to put that money in a different place, a place where the CRA expects it. So it's not the worst thing in the world to put it where the CRA expects it. But oftentimes for our client base, we are fighting to help them prove that they have legitimate business, which means we want them to have income. Part of the thing about having income is that then you get to have an RSP contribution limit. You get to have a potential to have income that will allow you to get a house because you'll have mortgage. You'll have income for a mortgage. So having a business which has income is helpful for a lot of reasons. I had a client who was a sex worker. She was like, I don't, it's all a little weird and I get paid cash, but I want to buy a house one day, so let's do this. Because she wanted to be able to show her notices of assessment to a mortgage provider and say, I make money. More power to her. It was really smart because she wants to buy a house. She doesn't want to be a sex worker for the rest of her life. So she claims her income. So having taxable income is really helpful for a lot of reasons. Having your RSP limit, being able to buy a house, showing income on your business goes towards that idea of having a profitable business. So you can put your T5 where you want to if you're having a strategy of trying to reduce your income for something else. But that's advanced strategy thinking right there. We'll talk about HST in a little bit. Abigail has a question.
Just to briefly follow up on the HST thing, I was actually contacted and said, you have to get an HST number. And I said, I make most of my money from grants and they don't provide HST. And so the person on the phone said, oh, okay.
Yeah.
Done.
So maybe we'll just talk about HST now because it's come up. It's okay. HST, when you earn $30,000 from freelance income, can be from any combination of different weird things that you do. If you're like a gardener and a babysitter and a musician and they're all treating you as a freelancer, all of that gross income, so all the total freelance income combined, if it hits $30,000 or thereabouts, you need to get an HST number. Who has an HST number here? Show of hands. One. Rob does. No, Rob doesn't. One. You have one. Only one HST number here. That's cool. Okay. How long have you had your HST number for? 20 years. Awesome. Okay. So Has anyone here thought about getting an HST number or know what it is? Other than Rob, yes, and Felipe. Doug, right? I heard your name. Guggen, I heard Doug from back here. Guggen, hi. Okay, so people are thinking a little bit about it. So when you are a freelance business owner, you have to get an HST number when you hit a $30,000 threshold. But there are things that are called exempt and zero-rated supplies. Grants are an exempt supply, so you do not get HST when you get a grant. So when you're looking at your threshold for freelance income, if it's all grants and it's $100,000, you don't have to get an HST number, but you will probably get a call like Abigail did that says, hey, you made a lot of money, where's your HST number? And the response can be, it was all grants. Or if you're a music teacher, music teaching is also an exempt supply. So if you teach music and you make 90 grand a year teaching music, you are still you're providing an exempt service. So that can be a real workaround for musicians who teach music, is that if most of their income is teaching, if their other stuff, if their performance is over 30, doesn't matter what they make as a teacher, they still have to collect the HST number because their non-exempt supplies are over 30. But if you are providing exempt supplies like teaching, or you're getting exempt income like grants, then you're not required to get the number. If, however, you are working in a foreign country, I'm going to get to your question. If you're working in a foreign country, that income is called zero rated. That means that it's not an exempt supply. It still goes towards your $30,000 of threshold of income. You just charge 0%. So if all you do is tour around the world and you're making $100,000, you're still getting an HST number because you're providing a non-exempt supply. Your income is HSTable. You just don't charge non-Canadians HST at 13%. You charge them at 0%. It's like a weird terminology where you charge anybody who's not Canadian 0% HST. So in those situations where if you are only working in foreign places and only collecting foreign income, but you're still filing a Canadian tax return, and you have to get an HST number, it can work in your favor if you're spending a lot of money in Canada. If you're touring, it's harder to do. But if you're collecting zero HST and you're spending HST, you get to keep the HST that you spend when you have an HST number. So HST works with whatever you collect for the government, you give to the government minus whatever you spend in HST. So, Felipe.
Just real world scenario.
Yeah.
Let's say I get a commission from a client in the UK.
Yeah.
I don't charge them HST.
You charge them 0%.
I charge them 0%.
You charge them 0%.
Okay.
Yeah. So you would put it on the invoice, you have your HST number on the invoice, and you would charge them at 0%.
Okay. But I'd still have to, I probably still get a call back from CRA regarding.
You might. They've made it easier for us to report our exempt and zero-rated income. The HST return used to be one line for income and one line for HST collected, and if there was a disconnect, they would call you and say, you made $100,000, you collected zero HST, why? Now they give us an option to have, there's two lines now for income, exempt and non-exempt income. So you can put your UK income in the exempt line, and that makes the math make sense. They might still call you, but if you say, I only work for UK companies and they're stationed in the UK, then you've done nothing wrong. Yeah. So HST that you spend, you keep. So if you do end up doing a bunch of zero-rated income, zero-rated, but you're working in Canada, so you're spending money on Canadian musicians and Canadian studio rent, and you're paying HST all along the way, you get to keep that HST. So if you collect zero HST, but you spent $2,000 just in the HST running your business, you get an HST refund of $2,000. So there can be places where having an HST number is beneficial. If you collect none, but spend a ton, you just get it back. So even though HST feels daunting, the administrative work is a pain in the ass and it costs more money to do your taxes, you can end up coming out ahead if you have a situation where you're not charging a lot. We have a lot of sculptors in our business. They make no money. Sculptors don't sell sculpture, but they spend a lot of money on marble and fabrication and this and that. So they get HST refunds every year. It's not a bad deal. I don't know why the CRA wants them to have an HST number because it just goes back in their face, but that's what the reality is. So with HST, if you think you're going to get to $30,000, it's probably worth seeing an accountant. Does anybody here actually go to an accountant? 2, 3, 4? Yeah, sometimes you're your own accountant. I like to encourage people to visit an accountant once in a while, even if they don't, even if they know how to do their own taxes and they're really good at it. Sometimes getting a fine tune or a tweak from an accountant can help if they've been going off, if a person has sort of learned a thing 20 years ago. Taxes change and the rules change all the time. So getting a reminder of the new tax changes, having an accountant say, oh, well, you've been charging the wrong HST in the wrong province. Not a bad idea. It's a good investment, and seeing an accountant is a write-off, which is a lovely thing. So I encourage people to see accountants, not saying come to me, but see an accountants can help teach you. When I was first coming to my accountant, now my boss, I wanted, we were talking about this earlier, Abigail and I, they don't teach tax and finance and business in art schools. They don't teach it. And you come out of art school ready to make art, and like Matthew was saying earlier, there's a disconnect between I'm an artist and the CRA wants something from me. One of the biggest problems that we have as artists is that the CRA has these rules. They say that in order to evaluate your business, do you have intent to earn a profit? And a lot of artists don't earn a profit or have a hard time earning a profit. But that's the criteria that they look at is, do you have an intent to earn a profit? You don't have to earn one, but do you have an intent? And so when we're dealing with our taxes, we're trying to show the CRA that we have an intent to earn a profit. So that can be a matter of showing our expenses, our advertising. What are the expenses that show that I have an intent to earn a profit? So if I'm investing in advertising or a website or in selling my records or in paying a gallery to sell my work, that shows an intent to earn a profit. So the CRA will expect you to run a loss for the first few years of your business, but after that, they want you to show a profit. And if you can't show a profit, can you show an intent to earn a profit? And they want your expenses to be reasonable in relation to your income. So the two terms, the main term that we talk about is reasonable. What's reasonable? When I was sitting with this auditor last week, he used the term reasonable an awful lot. What's reasonable? My sister's expenses didn't look reasonable to him because she's doing something that's a new weird, she's a social media influencer, which is it's a weird business. And it's the CRA hasn't caught up with the new models of income. And so a social media influencer, her expenses that are reasonable to her make no sense to the CRA because her expenses are hair and makeup and tanning. To me, it's all very weird. I don't really get it either. That's what she does. She's my sister. But the CRA doesn't think that they're reasonable. So now we're trying to fight the CRA to say, for this business, which is 5 years old, it's reasonable to be paying for tanning and nails. Who knows if it's going to work, but we need to be able to prove that our business's expenses are reasonable and that they're in relation to how we earn income. So she had to show this auditor on her phone, her Instagram with the video of her and say, when I say this, people touch this button and then they go and buy something. And she had to walk him through the back door of Instagram and show him her link tree. I'd never heard that word before. A link tree that showed where he had the chance to spend money because of her. She had to show a direct connection between what she talked about in her Instagram video and how she made money. And I think that she was able to do it. We don't know. They have to rule on it still. But you have to be able to show a connection between what you do and how you make money. So a lot of our clients make no money, because being an artist is really, really hard. But showing you have an intent to make money is important. So when we're looking at our expenses, tailoring them to my intent, which is really just like a website and advertising and selling CDs. I have a client who's a printmaker, and he never makes any money, but he teaches his art form. So when you teach your art form, you're an artist. But if you're teaching, you don't have time to make your art. So his business is kind of always in a loss because he's too busy teaching his art form to make money from his art form. But one day I said to him, where do you sell your work? He said, oh, I don't sell it. It's in a drawer in a gallery. And I said, well, you can't do all this stuff if you have no intent to make sales. And he was like, well, I don't really want to. You can't tell the CRA you don't want to make money if you want to run a business. If you want to run a business, which is how we deal with write-offs and expenses, then you have to have an intent to earn a profit. You can't say this is a hobby. I don't think anybody here is thinking that they're a hobbyist. This is not a hobby kind of a community. But you have to be like, I really want to make money. I want to have a profit. I want to live off of this. I don't want to have a side hustle. I want to make money. So did you have a, yeah.
Yes, there's a question here from Anthony. If you were employed at a university but also make a small amount of income as a freelancer, do you need to include that in your taxes?
That was the example that I just used of my printmaker client. When you make, the main rule is if you make money, you report the income. That's non-negotiable. Our only mandated job as Canadians who want to file a tax return is to report your income. That's your job. So if you have a full-time job, but you made $5,000 selling postcards, you're reclaiming the $5,000. You're going to make a business out of it and write off some stuff. But at the end of the day, our job is to report income. Their CRA has so many ways to catch us. They have a place on your tax return if you're claiming a babysitter for childcare. There's a place for you to put the babysitter's SIN number, because that babysitter, who probably got paid cash, they want to check out on the babysitter who claim that income. So there's a place for them for you to rat out your babysitter and say, I paid this 13-year-old $20 to watch my kid. Here's their SIN number. So cash income is taxable income.
So in this case, then, would they submit their T4 and in the normal part of the form, and then the other in the self-employment income?
Generally, yeah, that's the best place to do, because then you can write off expenses against it. So if they have a small sideline doing their art and they spent money doing that, if they rent a studio or if they have to buy art supplies, they should be writing off their expenses. The CRA wants you to write off your expenses. They want you to claim the reasonable stuff because you should. There's a question here.
Perhaps this is a good segue to write-offs for dummies.
Yeah, that's what we were going to segue into. So we have a little handout. This is an income statement. This is what most people's profit and loss or business statement looks like in real life. The government's version is a little bit more hackneyed, but you want your business to look like your business. So the CRA's version basically is just like office supplies and rent, telephone. But your business is going to have things like musicians, and it's going to have recording studios, and it's going to have instruments. So we want to be able to figure out and build your own income statement. So let's talk a little bit about what people think are write-offs, and we'll brainstorm it, and then we'll break it apart and see if it's actually a good write-off. So throw out some ideas of what you think are write-offs, and then we'll just talk it through. I have bad handwriting, so sorry. Cell phone. Oh boy, software. My handwriting. I'm really. It's not good. We got 3. Clothing. Travel. Internet.
Concert tickets or conferences that you have to pay admission fees. Professional development, I guess.
I think CDs, video games, and media count as research.
I hate talking in groups too, so I don't blame you guys for not saying anything. I'm the most silent person in a class, but please throw something out. We have so many more places we can be writing off.
Professional organizations like the CMC.
Good call. One of the most commonly yelled out first examples is people say dentist, which like their first go-to is dentist, but no one has said dentist here yet, which is.
Say anything to do with your body, whether it's gym membership, dentist, whatever, anything you're a performer.
Car expenses, gas.
Do we feel like we have all of our write-offs here?
Insurance. Especially for instruments and gear and anything that's insurable.
Tova, do you want to just run through these so that
We're going to run through them in detail.
Okay.
We're just brainstorming right now. Classroom supplies. Anything else? Do we feel like we have? Oh, yes. Home improvement. That's a TV show, isn't it? Does this seem like a business? Do we feel like we have a business here?
Web and hosting.
I mean, I talked about advertising being a really important expense just about 5 minutes ago, but no one is. Advertising is a really good expense, guys. So we're going to throw that on there, and then we're gonna run through this. Oh yeah, publicists and PR people, all that stuff. Advertising is a great expense. So now we're gonna break it down and talk about what's allowable, what seems reasonable, and there's a question. There's a voice from the outside.
Yeah, could we write off our U-file purchase?
U-file, so tax software. Okay. So the main things that people have that are write-offs that are really going to be standard, normal, run-of-the-mill are where we work, how we get there, and if we're eating. Basically, your sort of biological imperatives, that kind of stuff. People always want to write off that. And that's where things get tricky, because when you have a biological imperative or like a need that keep warm, this government wants you to be conservative with it. So rent and office, we talk about that. If you're renting an outside space, like you have a hot desk or you have a studio with music, 100% that's a great write-off if you're going to work. If you don't have an outside space, you work from home and you rent or you own, you can claim a portion of your home office expense. So on the second page of this, which is somewhere maybe in the third page, schedule of office rent is the second schedule. When you have something that you use for partly personal, partly business, you can only claim a portion of it, and what seems reasonable to the CRA is what, and you want to claim what would seem reasonable to the CRA. So in a house, you have to bear in mind that it's probably going to be closer to a quarter than it's going to be. I use my whole house to work in, because people will take their computer and they'll move it, and then they'll work in the kitchen, and then they'll work in the living room, and then they'll, you got to basically make an office in your home. So even though I'd like to prefer to work in my living room, I have an office. I don't like sitting in it. It's got no windows. I have an office. I use that part as my write-off. So the costs for me are the cost of running my home, my property tax, my mortgage interest only, my utilities, my house insurance, the cost of running my home. Nothing to do with the actual owning of the home, so not your principal on your mortgage. Yes, Felipe.
A percentage of it though?
Percentage.
Trillium something something.
Come back to that. Trillium is a benefit. Did you have something, Abigail?
Condo fees. I would
Condo
include
fees,
condo
yeah,
fees in that.
yeah, exactly. So condo fees. So the cost of running my home, I can take a portion of that for business purposes. So I write off. I have 4 rooms. One of them is my office. I write off a quarter of my home. If I had a grand piano, my neighbors have a grand piano. They probably write off a bit more because there's 2 musicians in a very small space and they have a grand piano. So you have to think about your square footage. The Trillium benefit is a credit that anybody who is lower income in Ontario is eligible for rent. Anybody in Ontario, you don't have to be freelance to get it. You claim a portion. You can claim your rent or your property tax. But if you're claiming a portion of your rent or property tax for your business, then you can't claim all of it for the Trillium benefit, because then you've double claimed. So if you do have a freelance business and you do want to claim the Trillium benefit, you can only claim what's left over after you've taken your home office. If I use a quarter of my home for business, then a quarter of my property tax is out of the picture for Trillium benefit. I can use 3/4, the remaining 3/4 to get the Trillium benefit, which is a personal credit, not a business credit. Right now we're talking about business expenses. Yes.
Okay. Personal thing here. I'm a musician. My husband is a musician. We both work from home.
Yeah.
I mean, what is feasible to write off of our place? Like, because I've been writing off a fair amount.
Of course, yeah.
Because we both use it.
So
So like, I might be, 35%. He might be 35%. Is that realistic?
The tricky thing about home ownership and running a business from your home is that you can never touch, you want to keep part of your home as personal for the sake of when you sell your home, if it is your home that you own, it's a tax exempt income when you sell your principal residence. If you make a profit on your home, you don't pay tax on the profit from the sale of the home. But if you make your home a business, and it's more than half of it is business, you can potentially run into a problem of having to pay profit on the portion of your home that was business, which is why we never touch the actual home. We never write off renovations. We never write off the principal on our mortgage, because that creates a capital gain on the sale of your home if you assetize your home. So an asset is something that has value beyond the first use, like a building or a car or a grand piano. So when you assetize something like your home, you create a situation where when you sell your home 10 years from now and the housing market is booming and you're going to make $1 million, you're going to profit $1 million. If you've made your home into a business, you'll pay tax on that business income, on that income. Yes.
But that wouldn't be a problem if you're leasing.
But that wouldn't be a problem if you're leasing or renting, for the online people. It's not a problem if you're leasing or renting, because you're not paying capital gain when that house sells. It's not your. So if you're renting or leasing, you're just claiming the rent portion as opposed to the property tax and mortgage interest. And if you're leasing your car, you can claim the interest on your lease. We'll talk about car in a minute, but basically your house stuff, keep in mind that it's the running costs, not the actual purchasing if you are purchasing. So the running costs, if there's repairs, light bulbs, cleaning the windows, a furnace repair, painting, that kind of stuff, goes into repairs category. We take all of that number, all of those numbers, all the running costs, take a portion of that as business, and the remainder is personal. We don't touch it, or we use it for our Trillium benefit, the portion that is the rent cost we can use for our Trillium benefit. So that's the main thing about our personal use home, is that we can only claim a portion. You want to try to keep it under half if you can. If the office is legitimately just like, if you come here and you're renting out that room, Matthew has to move out for a minute, and you rent out Matthew's office, writing off all of that because you come here for business is allowed.
The question I had was,
Hold on for that second. I'll give you the mic. Yeah.
all right. The balance of claiming those things, a balance of deciding what I want to do for Trillium and what I want to do for as far as going against my my business.
Well, you want to put everything you can against Trillium, because that's a credit that anybody can get. So it's basically whatever's left over. So if you use, you're going to save, there's a difference between I'm going to save tax if I claim my home office, and I'm going to get a nice little credit if I use the Trillium benefit.
Right.
And the credit is a maximum of like a $600, $700. You
So in
might
other
you
words-
might save $1,000 claiming a quarter of your home office, and then get another $700 for claiming the other 3/4 for Trillium.
Right. So okay. Right. Okay. I'm just trying to figure out like what is the threshold, our own personal, imaginary threshold for, okay, when my income gets up to here, that's when I should really start putting more of that towards.
It's not
claiming
about
that.
how much you use of this. It's not about how much money am I going to put against this. Literally, it's just what's the square footage. That's my claim. Like if I use a quarter of my house as my office, then a quarter of my expenses are my office expenses. That's not about how much I'm using it. It's about square footage. So,
But in real dollars and cents, what's
But that's-
what's
but
better
that's-
to have come back is a Trillium benefit or the
it depends on your gross. It depends on your gross income, and there's
what I'm
not,
saying, yeah.
but there's not really any math, right? Like if I use a quarter of my home as my home office,
Right.
then a quarter of the rent is going to be used for that, and the other 3/4 is going to Trillium benefit. You can use all of it in two different places, but like, I don't know what your income is. I don't know if you make $60,000, you're not going to get the Trillium benefit.
right.
If you only make 20, you're going to get the Trillium benefit. So
I was
it's
just
all
wondering
income.
whether you knew there was a magic number that.
Yeah,
this
there's
is sort of
you
where-
get Trillium up until about 40, but it scales down. It gets clawed back. So,
Yeah.
and that's just, the Trillium benefit is a nice little benefit. Your home office is going to save you tax.
Okay.
It's going to save you more tax than you're going to get from your Trillium benefit.
That's what I'm asking. Yeah.
Generally, but I can't speak specifics to your numbers,
No, I
but
know, yeah.
you want to claim your home office regardless. Back there, there's grab that mic.
Could you explain the Trillium benefit once again?
Sure.
I may have missed that.
Anybody in Ontario is eligible for the Trillium benefit, but it's for people who are lower income, and it's a combination of your sales tax credit and your rent or property tax credit, and it can maximize out at about $1,000 per person. When you're a couple, I think it's about $1,700 per couple. So it's like if you're married or common law, it's one credit per couple. Only one person gets it. They get more. Generally, you got to share it with your partner. But basically, it's just a place. If you're doing your own taxes, the software will say, did you file your tax? Did you pay rent this year? If so, plop your rent here and the name of your landlord. So basically, it's a credit. It's about $700 if you paid rent, but it's scaled back the more money you make. So if you're not making a ton of money, you'll get a full $1,000. If you're making $60,000, you're not going to get anything. But if you're doing your taxes with your accountant, they will opt in for you. And if you're doing it by yourself with TurboTax or you file, it automatically just figures it out for you. So you don't it's not what you need to think about particularly. It's not part of your business. Abigail.
Yes, follow up online. So always keep these claimed home expenses at less than 50%.
Ideally, yeah. I mean, you want to really just be looking at your square footage of your home. Like, most people don't take half of their home as their office. You have a bathroom and you have a kitchen, and those are basically already personal, right? So,
Although if you're a music teacher and you're using your bathroom as part of it, then...
But you're not using your bathroom 100% for business.
No.
You know, so you can start to nickel and dime it, but I've had a client who was audited for his rent. He's a sculptor. He said he claimed 10% for home, 90% for business. They just allowed the entire thing for like 5 years, and he was scarred for life. Like, it's not a fight worth going to the ends of the earth for, your home office, because it's the one that they're going to easily say, like, no, you live there. Like, there are other expenses you could more reasonably fight and prove our business than your home office. Like, claim a portion that's reasonable. Don't get greedy there. So home office, your home, your food, your clothing are the places where they are the quickest to say, no, it's personal. So don't go to the mat for those ones if you don't need to. Take what's reasonable. So we've talked about this. It's a good expense. Clothing here, based on my sister's audit, good luck getting clothing through. If you buy costumes, if you are buying a tuxedo to perform in front of a bunch of people, and the tuxedo goes into your costume part of the closet, so you have a costume portion, you have a tickle trunk, it is separated out, absolutely claim it. If it is just, I like to wear black jeans on stage and then I wear them to the corner store, not a claim. It has to be business related. So I have a client who bought a cape because she's in a rock band. I was like, cool, a cape. That's a costume, but her jeans were not a costume. So it has to be costume. It has to be related to only performing.
Well, if we talk about business meetings, if we talk about business meetings, let's say we're having a lunch, right? That would be considered a write-off.
Well, we're still talking about clothing right now.
Yes, but I'm circling. I'm circling.
Okay, we're talking about food in a minute. Yes.
So, you don't show up naked. You show up looking okay, right?
But you don't show up naked because you don't show up naked, not because
True.
you're trying to, like, it's not.
But then couldn't you at least say, if it's not for performance, let's say a suit or something like that? No? Bad idea?
Anything that's sort of personal and required for just being a person is going to be harder to fight.
Okay,
so
bad idea. Cool.
Clothing is not, again, clothing, food, housing are not things to go to the mat for. They're just not worth it.
And then for clothing still, like I teach at U of T, and so, I don't want to show up in a t-shirt. So like, would dress shirts be appropriate as someone has to stand up in front of a class?
Do you wear them to your cousin's wedding the next weekend? Like, if you have a costume section of your closet and it is costumes, have at it. If you do not have a section that is separated out as, I only wear this for work, then it's not really worth it. As an actor, people are always like, I write off everything. I wrote off a pair of scrubs that I bought. Like, I don't do it. It's not worth it. I had to buy scrubs because I auditioned to play a doctor all the time. It is my new category is doctors and nurses. Tomorrow is a pharmacist, literally. I bought scrubs. I had to buy an orange t-shirt once. That's what I write off. It's not worth it for me. This shirt's in my headshots. I wear it all the time. It's in my headshots. People see it as a professional shirt, but I'm working today, but I don't write it off. It's not worth it. It's not worth it. It's not worth it. Yeah.
What about like black formal dresses
Yeah.
for gigs?
So tuxedos, that same kind of things. If you are in an orchestra and you need to be wearing a specific thing and you only wear it on stage, so it's a costume. Costumes are allowed. Call it a costume, don't call it a nice dress.
Okay.
Call it a costume. Just if you buy costumes, it's a whole different category than I bought a nice white shirt. It's just different. So learning also the terminology of what's a business expense versus what's not a business expense. Costumes are a write-off and nice shirts are not. So clothing. Make sense? Food. Yeah. Grab the mic because you missed the live stream portion where there are people listening. There's a lady back there.
So then I'm also a performer. So then if you're doing like nails, hair, and makeup just for that particular performance,
I
can
would
you
write
write
that
it
off.
off for that?
Yeah,
Okay.
for that particular performance, if you are doing a big thing and you need to, do a thing,
What
I would do
about
it.
like a haircut because that lasts after?
I personally write off my haircuts because I have to look at my head. I have to look at my headshots.
Right.
If it was going to get contested, I wouldn't be surprised. But I write them off. You have to look at what your business does. I go to auditions on a weekly basis. I got to look like the same. I got to look the same as that photo that I'm wearing this sweater, and I got to look like that same photo every week for 5 years now. I keep my hair looking like that photo because then they know who I am.
I've never written off as a performer, but as a sales, I used to work in sales in Alberta, and I wrote it off for that as well as suits.
Eh,
It's just different.
iffy. That one would be more iffy than writing it off as a performer to me. Yeah.
I just want to follow up on this a little bit.
Yeah.
I think I'm going to ask what we're all thinking is what's going to set off alarm bells? Like, is there a percentage? Is there a number?
No.
Like, if we
have no idea. we have no idea. Like I was saying before with my sister's audit, I asked the auditor what it was, and he said no, he doesn't know. There are algorithms, and the more we are now required to electronically file your taxes. Before we would just pop them in the mail, and the CRA would get a print out. Now we electronically file it. They're basically getting a barcode with all of our information, and they're building these algorithms to catch things. And we don't know what they're catching. We don't know. Like from one year to the other. This year it was Ontario Arts Council grants. They're what they were looking for. We have no way to know, and it's not worth worrying about particularly. We had a client a bunch of years ago who owned a hair salon, and she was audited. And at the end of the day, they picked 2 categories to audit, one of which was her waiting room supplies. And anybody who's ever gone to a hair salon knows that you go and you have a cup of tea and you drink a shitty magazine, and you're like, this is the best. I'm getting my hair cut and I'm reading People. They disallowed her magazines, which doesn't make sense because when you go to get your haircut, there are magazines there. Like it's a standard industry standard to go and read a crappy magazine at the hair salon. And this auditor just said no. We don't know why. He might have been bald. He might have had alopecia. He might have never had a haircut in his life. We don't know. He said no. She spent more money fighting the audit than she ended up having to pay. She's consulted 2 different accountants. She got like a tax lawyer. She ended up having to pay like $200 for the audit. She spent $2,000 fighting it. So you can get worked up about an audit. It can be nothing. My sister's audit, they're auditing 5 categories. If they'd gone any deeper, she'd be screwed. They picked 5 categories. They could have looked at that. There's 20 categories on her return. They're only picking 5 to audit. So she's going to be screwed because it's a lot of money she's dealing with. But this hairdresser, $200. So it's not really worth losing sleep over an audit. We don't know what triggers it. And if you have integrity and you think that you're claiming reasonable stuff and you can argue it, when I have clients who come in and say, I need to write off this outfit, I'm like, well, then pretend that I'm an auditor and tell me why it's important to you. And I make them argue with me about why that thing is so important. If they can convince me that it's business related, I'm going to let them do it. But they have to be able to argue convincingly that it is a business expense. So if you feel like you have integrity when you're reporting your expenses, and you can argue that they're business expenses, then you're doing your job as a Canadian citizen to report your taxes. So don't lose sleep about it, but just try to have integrity and try to just have an argument in the back of your mind if you feel like it's a little bit gray. Clothing is costumes. If it's a costume, it's allowed. If it's clothing, it's not. Food. We had food somewhere. Meals here. Because we have a biological imperative to eat, we can only claim half of our food. So whenever we're claiming food, we reduce it by 50%. The accountant or the software will reduce it by 50%. So your job is to bring up your total food expense. We reduce it by half because of the biological imperative. The rules of food, there are basically 3 places you can put food in a tax return. One of which is, they call it business entertainment. That's the name the government calls meals, is business entertainment. It is this little thing here, full amount, half to claim the rest. It's page 3 of your income statement. That is business meals or drinks with somebody. You've got to be with somebody. They've got to lead to a line of income. So if I go out and meet with another tax preparer whose office is hiring, I'm trying to get a job there, I can write it off. If I'm going out to meet with my mom, I don't write it off. So it has to lead to a line of income. It doesn't have to mean that you got the job or that you actually got work, but there has to be a connection to income. So that rule is, in my city where I live, I claim this meal because I was with somebody who led me to a line of income. I don't have to buy their food. I can go Dutch. I claim half of it. So that's in-town business entertainment. When I am forced to leave my home by more than 40 kilometers overnight, so travel, I can write off food that I have by myself. So if I have to go to Montreal for a weekend to do something, I grab a cup of coffee at the train station, I can write off that coffee. Again, only half of it, but I can be by myself because I'm now on business trip. So place 2 for food. Place 3 for food is if you are doing catering for an event. So say you have an opening night or a reception or a party and you're feeding 50 people. Don't put it into your business entertainment category because that's only claimable at half because you ate half of it. You didn't eat half of the food for 50 people, so you'd claim catering and receptions as a full amount because you fed a lot of people. So 3 categories for food: in town with somebody, out of town with or without people, or feeding a party. 3 places for food. There was another question back there with Rob first, or did you? Yeah. 40 kilometers. The distance for travel is basically 40 kilometers.
Sorry, just to clarify, where does the catering area go?
You can, so we have just a catch-all for varying expenses, which is on page 1. And all of these expenses, this was your cheat sheet right here for what's going on here. You can make a line for catering. Like this is a template. This is a sample of what somebody would be, but you would just make a category for catering. I'd probably put it into advertising if it was going to be lumped into the CRA. Catering, receptions is going to be advertising. If I'm making a movie and I'm feeding a crew, it would probably go into cost of labor, depending on what I'm doing, but it doesn't go into business entertainment because that is a category for 2 people, of which half goes away. So catering is just its own thing. Yes. Grab the mic.
So if you're feeding a crew, does that mean you're still writing off 50% of that?
No, that's why it doesn't go in that category. It goes in its own category, like catering or a crew is its own category, so you're not losing half.
Okay.
Unless you eat half of that food, you shouldn't be losing half of it.
Right.
Okay, so those are the big 3 people always want to know about because we spend those every day: food, housing, clothing, all claimable to an extent. You just have to be reasonable and careful with them. Beyond that, getting around town, so gas, car, transit. The car rules are similar to house stuff in that if you're running a car, you take the running costs of the car and take a portion of that based on how much you think you use it. Now, there is a rule that I just learned, which most people probably don't apply, which is that your first stop of the day isn't allowable. So if you drove from your home to your office, that stop isn't allowable. Most people claim it regardless. Your discretion there, but if your home office is your main place of work, then your first stop out of the house is then allowable. So if you have your office at home and you drive to your studio, then that first stop is allowable. So the running costs of a car: gas, repairs, insurance, maintenance, parking permits, all of that, add it all up together, take a portion that is deemed business. The CRA kind of wants a mileage log, but no one really does that. But even if you take your odometer once a year, on Jan 1, look at your odometer and you know how much you drove for that year by checking it the year later and take a percentage of that, just be reasonable about your car usage. If you rent a car for a day to go to a place, 100% of that is business. But if you're running a car full year, take a portion of that. Yes, back in the end, let's grab that mic. Get you on the onlines.
This is a slightly more personal question because I do rent cars on a weekly basis for out of town gig.
Yeah.
Would it be better then, based on what you're saying, that to keep renting cars as opposed to owning one, because then you would be able to save more in the long run?
Depends on how much you're renting. I have a client who spent
1 day rentals, like once a week, basically.
How much does that cost you? Because
$40-50.
Yeah,
plus
owning a car is going to cost you like $8,000 a year. So you're saving money by renting. I have a client who spent $36,000 renting cars last year. $36,000. I was like, please buy a car. And she said, I don't. She said she didn't want to. She was happier this way. And I think that's fine. If she doesn't want to, this is what, she didn't want to own a car and she can afford it, then fine. But like, really, it was stupid. Whatever's most financially viable for you. If you're renting a car specifically for that gig, then it's going to be right off whether you own a car or not. Like if you owned a Mini, but you needed to rent a truck once a week because you were a drummer, then you're going to use that rental for business because your Mini doesn't hold your drum kit. That's okay. So the gas, if you're getting if you have a Presto card, register it. If you register it, then you can get a report once a year of how much you spent, and that's a really great way to use your taxes. Spent $2,000 on Presto, half of that was business. Math is easy. Do you have a question? Yes, grab that mic.
I could have sworn I saw something a couple of years ago that the TTC Metro passes aren't.
There was a personal credit for Metro Passes that was a Canadian-wide credit. If you bought a Metro Pass as anybody, business or like not non-business related, there was a Metro Pass credit that you got for just having a Metro Pass, for having a bus pass, a monthly pass in any province. That credit is gone, but our business usage of Metro Passes isn't gone. That never went away. Just the Metro Pass credit for general population, that one is gone.
So as freelancers, we still get to track our Presto and
Yeah.
gets.
Absolutely. Presto, Ubers and Lyfts and cabs. If it's business related, keep track of it. It's easier to keep track of the Ubers that are business than to keep track of all of them because that's a pain in the butt. The same with your Green P parking tickets. If you're just keeping track of your business related ones, it's less math to do. Presto card, you're going to get that report at the end of the year, so that's really easy. But keep track of your getting around town. The big categories that we spend money on are housing and getting around town, and they save you a lot of money. So keep track of them. They're really, really worth it. Oh gosh, never let me write on a dry erase board again. Okay, okay, let's start from the top here now because now this is everything else. Tax software and bookkeeping is a great expense to have. You should totally pay to have your taxes done. Whether you're paying for UFile or TurboTax, or whether you're paying for QuickBooks or FreshBooks or Wave, those are really, really good business expenses, and they improve you have an intent to earn a profit because you're tracking your business. It's a good expense. Paying an accountant, having a consultation, if you were paying to be here today, would be a good write-off. All that kind of stuff. Great write-offs. Super good. Do it. Studio gear. Studio gear really there are different ways of claiming your gear and your musical supplies based on the thing about if it's an asset or not. So if you bought a grand piano, that piano has long-term value. It's going to depreciate year over year, and you have to do something called depreciation on your taxes. That gets a little funky, so you should probably be getting into having an accountant if you're dealing with weird depreciation stuff. But basically, there are schedules. Things depreciate at different values. Computers go at 55%, and cars are at 30%, and drones are at 20%. It depends on what you're doing. But if you're buying something that costs basically $500 for an individual item, $500 or more, like a car, like a mixing board, like a piano or whatever, it depreciates. If it's $500 or less, it probably doesn't have the same depreciation value. You can lump it together into music supplies and call it a supply. Felipe, grab the mic.
Interesting that most things tend to depreciate over time, but couldn't one claim to the CRA that some things actually gain value over time?
They do, and then you have to pay tax on it if they do.
Oh, okay.
Yeah.
Oh, geez.
So you depreciate it, but then if you sell it, you'd have to pay like a tax on the appreciation.
Okay.
Yeah.
And with regards to software, for instance, a lot of software now has gone on
monthly
yeah. subscription
Yeah.
basis. All of these are also you can
Yeah.
put them against.
I put that against office supplies, or I make a category now called online subscriptions because everybody has online subscriptions, whether it's like a Dropbox or like a G Drive for storing things or
what happened?
whatever your software is. It's basically an office supply at this point. So if you were to buy, back in the day, you would spend $1,200 on a really big piece of software. That would be depreciable. Software depreciates at 100% over 2 years, so it goes pretty quickly. But now it's just monthly stuff, so it goes. It's basically a current expense as opposed to a depreciable expense. So current, I used it, it's gone. The expense is used in the moment, it's gone. Versus an asset where there's a value where you could resell it. So I could resell my car next year for money, or my computer, or my drum kit. Those have value. They are depreciated. Back there.
The software also include things like Photoshop, music notation software,
Yeah.
apps that you pay for.
Same threshold,
Tuning.
$500.
Okay.
If you spend $500 on like a thing, like you paid $500 in one go to buy a software, it depreciates. If you're spending $500 in the course of $25 every month, it's just a monthly supply.
Okay.
And pass that mic back over there.
What about hard drives?
$500. If it costs $500 for a hard drive, and that's if it's like a big hard drive, it's going to be an asset. If it's just like I spent $200 on one last year.
But hard drives die.
Yeah, but
very quickly. I don't know.
If you spend $200 on it, then it just doesn't get depreciated. You actually don't depreciating. Just means you're delaying the claim of the expense. If it's under $500, you get to claim the entire thing in one go. So it just basically becomes an office supply versus an asset. So if I spent $1,000 on an amazing hard drive, it has long-term value. I assetize it. If I spent $200 on a crappy little hard drive, I throw it into office supplies and claim it in one go. So if it's small, it's just small supplies. If it's big, it gets handled a little funky.
I wasn't going to ask a specific question, but we probably a lot of us use or have cars. What is the depreciation
On a car?
on a car?
30%.
30%
Yeah.
per year. Okay.
Yeah. And in the first year you buy an asset, there's a half-year rule where you can only claim half of the value to depreciate before you write it off. If you're doing all the assets, get an accountant. It's just not worth fucking around with asset categories, but it's 30%. 20% from almost everything that isn't a computer or software or a car. So musical supplies are 20%.
Yeah, I'm interested in like what happens if you sell an instrument, for example, that was never actually logged, like it didn't come down on the CCA, and every year. Actually, this instrument was purchased probably over 20 years ago and now sold for like a $10,000 profit.
Yeah, that's
still
taxable income.
That's taxable income.
Taxable income, yeah. Yeah. If you had been depreciating it, you could recapture the asset if the asset still had value, and then you'd be paying tax on the recapturing of the asset, which is, we're getting into accountant speak, which is boring, but basically if you have an asset that still had value when you sell it, you have to pay tax on what's left over, which is, or the profit. The profit in this case, you'd be paying it's taxable income.
Okay.
Business line of credit. Yeah, if you have a business line of credit and you're paying interest, you can claim the interest. If it's a business bank account or a business loan or if it's business related, you can claim the interest. Not the payments, because that's the principal, but the interest on things. So bank fees, if you're paying for wire transfer fees to get money, or you're emailing your musicians money, interest, yes.
Okay. Does that include credit cards?
Yeah, so we know that Felipe has a business credit card. His interest or annual fee would be claimable. If it's a business dedicated, has to be business dedicated, right? So if you use
if I use my personal credit card for business expenses,
then you could use a portion. You can claim a portion of it.
So that's just a matter of being able to justify it to
Yep.
an auditor if it happens.
Yep,
Okay.
exactly. Okay, so
We have
studio.
A question here from online from Anthony. Just wondering about receipts for casual gigs that pay cash. I play for choirs every now and then, but it's not a fixed position. Is it my obligation to request a receipt of what they paid me?
It's nice if they give you a receipt, but your obligation is to record the income. However you record the income is your business, as long as you claim the income. They should be giving you a receipt, but if not, you're still claiming it. People get cash gigs all the time, or they get paid weird money. It's not their job to keep track of how much money you made. It's your job to keep track of how much money you've made. So if you have 10 different weird, odd jobs, just having a notebook and writing down that I made, or like using your day timer, today I made $50. Like, your job is to keep track of how much money you made and report it. That's your main job. This stuff is the gravy that saves you the tax. So bank interest, cell phone, personal percentage of it. So take a portion that's business, a portion that's personal, but your cell phone and your internet, you can apply a portion, remembering that cell phone now we use data and all that stuff, so probably you claim a lot of your cell and a lot of your internet, but leave some as personal, because we call our moms or somebody, call somebody. Travel, if it's business related, yes. If you're going to your cousin's wedding and you're trying to make it into a business trip, no. I have people who always go to their cousins' weddings in Ireland, and there's always a business trip. It's got to be a business trip. If it's a percentage of it is business, like I went to England and I saw a play, I took 10% of that trip as business. It was a very hard stretch for me to make it a business trip. But if it's a business trip, claim it. Your flights and your baggage fees and your travel insurance and your accommodation, your Airbnb or whatever, the food. Again, you can be alone for that, claim only half of it. Gifts, if someone's hosting you and you give them a gift, all that kind of, yes.
So if you need to fly or take a train to a gig, make a gig, but you can only count half of that. Is that what you're saying?
No, only food is the half.
Food is the half.
Food is always going to be claimable at half unless you're feeding a crew.
All right.
But if it's personal food, it's only half. But everything else, if you're flying to New York to do a gig, that's business.
Okay.
You claim the whole thing.
And the place you're staying at.
Accommodations, if you're billeting, food, we do that little bit of math. But if you go to New York and see a show, if you, all that stuff.
Right. Okay.
Yeah. Travel, internet, admissions to shows. If you're going to see something that's in your field, write it off. I used to write off going to see bands. It's just not in my field. I don't know what I was thinking, but I used to do it because it was a write-off. It has to be in your field. So if the admission is to go see music, great. If it's admission to go see something that's in your field, like it's a play that you're going to score or a movie that you're going to score, that kind of stuff, yes. If it's going to see the next Oscar movie, maybe not, unless you're scoring for movies. Use your... Could be. You have to be able to just rationalize it. So just be able to rationalize your admissions. I can't write off my band seeing because I couldn't rationalize it. Yes. Let's grab that microphone.
So actually, can you talk about that a little bit? Because I am a film composer and I'm a performing musician. And so but I work in different genres like jazz and musical theater. Mm-hmm. So for when I go and see something, what can I write off my tickets from TIFF? Can I write off?
If you think it relates to your business or your research or your professional development, then you should do it. You have to just be I have to connect the dots. I used to work for a record label, so I used to write off music because I worked at a record label. But when I stopped working at the label, I kept going with the bands, and then I was like, but wait, now I can't rationalize this anymore because I don't work at the record label. Now I don't do that. So you have to be able to connect it. But I go see movies all the time, and I write them off because I'm getting research for me. If it's research for you, if you can justify it, then you should claim it, or percentage or whatever. And that goes into your research and your media. So if you're buying professional periodicals, if you books, play scripts, scores. What are those things? Scores, words with notes, those things. Sheet music. Yes, write them off. Absolutely. CDs, yes, people will still buy them. CDs, iTunes, Spotify. If you're a musician and you're listening to music for research purposes and you pay a monthly fee to Spotify, yes, then do it. Memberships. So to the CMC or to TIFF if you're a film composer, or to whatever your memberships are, to SOCAN, I think you have to pay to join SOCAN. There's no joining. No? You don't?
No, that's free, but Canadian League of Composers, we'd have to pay.
There you go. Those fees, great expense. They show you have an intent to be a business because you're joining a professional association. When I was applying for a green card in the States, I had to provide proof that I had joined a professional association because that proved that I have an intent to earn a profit. So I had to join SAG or whatever because that made me look like I was a professional. So the same way, joining these kind of companies proves that you have an intent to earn a profit because you're belonging to a professional group. So it's a great expense. When you're looking at trying to prove you have a business and intent to earn a profit, memberships in organizations that are professional in nature are a great expense. Classroom supplies, someone is a teacher, I'm assuming. Classroom supplies, that was you, yeah. So if you're buying stuff for your students, like sheet music or stickers or whatever, then yes. If you're teaching and you need to buy stuff for your students, absolutely a great expense. Donations are a personal expense. They are allowable for tax returns, but they don't go in your business. They go in your personal, the same way that medical does. So we are allowed to have expenses as a person filing taxes as natural expenses. So my childcare, my health expenses, my donations, those are personal expense, same way Metro Passes used to be. They don't go in your business return, they go in a different part. So donations to charities, they are a great expense. They give you a 29% tax credit on anything over $200, which is really great. Give to charities, get a credit, not a bad thing to do. If you're giving to a donation to a Kickstarter or a GoFundMe, that's not a charity. It could be a professional gift, which no one mentioned, but gifts are a great expense. Gifts to my agent, I give my agent a Christmas gift every year, I write it off. Gifts to composers, whatever, great expense. So gifts to Kickstarters or GoFundMes or donations are not donations, they are gifts, they can go in your business. But if it's a donation to a charity, it goes in a different part of the return, that is a personal part of the return. Does that make sense? People give to Kickstarters now all the time. It's probably going to be a gift and not a donation because it's not being given to a certified charity. So donations are great. Depends on where you put them. Gym and body, people always want to write off your gym and your body work. It's really, really hard to. The gym, the government just says no, so don't bother with the gym. With body work, It really depends. So I had a client who's a tattoo artist, and his arm from doing this all the time, he needed to get physio. So that became a part of his business, was getting physio to keep his arm healthy. But it was not a medical expense. It was a business expense because it was for tattooing. If it's really required for your business and it's not a medical expense, if it's like Alexander technique or something like that, then claim it as your business. But if it's a medical expense, it goes in a different part of the return and you get a nice credit for it. So medical expenses are things like massage and chiropractic and acupuncture and physio and naturopathy and dental and glasses and orthotics. All of those things are a medical expense that go in a different part of the return, not your business.
From Deborah, when we write off expenses, should we claim amount with HST added or the pre-tax amount?
It's a good question. It depends on if you have an HST number or not. If you have an HST number, you take the HST out. If you don't have an HST number, you just leave the HST in. Because HST is not an expense for HST purposes if you don't have the number. It's just an expense. This is a part of your expense. So medical is personal, still claimable, but not in your business. So no gym, maybe body, yes, medical. Always gifts. Gifts are great. Where are we at? Home improvements, we talked about this a little bit. With renovations, we don't touch renovations because it creates that asset thing with if you own a home. So no home improvements unless they're just like repairs. I can see myself on the TV there. That's a bit creepy. Sorry. Anyway, distracted by myself. That's kind of a no. Car gas, meals, postage. Postage is an office expense, totally allowable. If you're mailing Christmas cards to thank them for buying your record, it's a great expense. Insurance is a great expense if it's for your gear. It's not a great expense if it's for your life. Life insurance is not an expense we claim because if someone draws on that life insurance and we've claimed it as an expense, it's taxable to them. So we'd rather it not be taxable, so you don't claim life insurance, but you can claim insurance for your gear, liability insurance, car insurance, parts of your house insurance, just not stuff that's related to like long-term disability, life insurance, none of that stuff. Health insurance can be making most of your money. You can claim your health insurance as a business expense to provide your business, which is you, with health insurance. So a variety of places for insurance, but generally speaking, just keep your insurance entirely. Web, advertising, they're just the best expenses because profit. So website, web hosting, web design, involved with that seems like everything, hosting and design. Yes, grab that microphone.
As far as the insurance goes, it's funny, for years people keep saying, have you insured your hands yet? And I have to keep saying no. I think they're like, you're nuts. You're crazy. You depend on your hands for
That sounds like liability insurance then. Like it's not. I think
that doesn't count toward a business expense.
that sounds like a business expense. 'Cause it's liability against your ability to work, which is it's work insurance, right?
Okay.
Because it's your ability to. I didn't know that was real, that you could insure your hands. Is that really a thing? You can insure your hands?
Apparently, I haven't got it yet.
That sounds like work.
Should
That sounds like
save a lot of my colleagues.
yeah. Basically, this has to be relating to you being able to keep working. And I would say that kind of insurance is related to you keeping working, as opposed to life insurance, which is you died and left your dependent penniless. Nothing to do with you keeping working. It's to do with keeping your dependent supported.
Okay, so that confuses me a little.
I know it's confusing, isn't it?
If I lose my hands, God forbid,
Yes.
can't work anymore.
No.
But so it's not really contributing to me keep continuing to work. It's contributing to me staying alive. because I can't work
It's like wage replacement.
anymore. Okay, and that's fine.
I would say it's like liability insurance is allowable because it's like if you get liability insurance, people who are going to walk onto your property and they fall and they break their head and they want to sue you. That's liability insurance.
Okay.
Same thing with your hand being damaged, as opposed to long-term disability. Long-term disability we don't touch. I don't know. That's a really interesting question, and I haven't ever had anybody ask me that question before.
Okay.
I don't know. It's interesting. We'll have to look. I'd have to look into that. But if you do, let me know. I'm an actor. Yeah, and there's nothing about me that's insured. Nobody cares about my hands or any part of me. Nobody wants to hire me. It's totally fine. So I wouldn't. But I think that Taylor Swift insured her legs. I don't know. Is that really a thing? Did you have a question? Yeah.
So to kind of develop on that, going back to the body and the gym.
Yeah.
So you were talking about the tattoo artist that had to get physiotherapy.
Yeah.
And I'm a pianist, so I've gotten physical therapy and massage for, is that something that you can write off, or a portion that you write off?
I think you can, depending. So in all of this conversation, it does come down to, does my business still look like I have an intent to earn a profit? If I'm spending all sorts of money on clothing and food and physical therapy, and it seems really legitimate to me, but my business is losing money, I wouldn't claim it, because I don't want my business to look like it's a shitty business. I want it to look like I have an intent to earn a profit. So when I'm strategizing with a client and I had a client who came in, she'd made $6,000 last year. $6,000. She spent $42,000 to make her business happen. I just said no, because it wasn't worth, it looked real bad. She was living off of family money, and that was fine, but it didn't look like a good business, and it wasn't helpful to her to run a $42,000 loss on $6,000 of income. It looked stupid. It looked ill-advised. So if you have all these expenses and they're all really, really great, but you've made no money, then it's not always worth claiming the expense, because you could open yourself up to being a bit more potentially audited. We want to show we have an intent to earn a profit. And sometimes that just means getting rid of some of these expenses like food and clothing, focusing on my advertising and saying, I'm a business. I really have an intent to be a business. I belong to composing societies, and I advertise my business, and I'm a business. So I might pay $10 in Canada pension, but I have alleviated any weird red flags. So whenever I'm dealing with somebody who doesn't make a ton of money and they have a ton of expenses, I have to apply the filter of optics. What are my optics with the CRA? Do they feel reasonable? If they don't feel reasonable, we're going to scale it back. There's also a credit you can get called the Working Income Tax Benefit Credit. It's actually changed names this year to something else. But it's a credit for people who are what they call working poor. So you work, you make $12,000, but you're not really making any money. You can get a $1,000 credit back. So sometimes people will come in and they'll have made 20 grand, and we'll just stop with the expenses because we want to get them that credit instead of taking the loss. So you can make $1,000 if you claim 12 grand of income. So if you've made a little bit of money and spent a lot more, sometimes we'll just say, let's get rid of the expenses. They're not really worth it because you're going to get more money back if you actually make money. So sometimes it's a matter of if you make money, you can actually get a better refund. So there are strategies to apply to people who have expenses where it's not worth those expenses because I can get you a bigger refund without them, or I want to get a mortgage, so I need to have some income. You don't always want to claim everything because there can be reasons why you want to have income.
What is that working credit called?
It was called the Working Income Tax Benefit Credit. It's just changed names this year to something called the Canada something. I'll find out. Hold on. Oh goodness, they just changed the name. Canada. It's like not the CCB. WITB. What is it called now? I've never Googled something. Canada Workers Benefit, CWB. It's called the CWB now. So it's about $1,000 per person for a family living. For family living together, you need to have made about $24,000 to maximize the credit, and for individuals, anything under 17,000, between 9,000 and 17,000, you have to work. You need to make money to get the credits. If you make $0 because you spent all your money on expenses, you don't get it. You need to make some money to get it. So getting between 9,000 and 17,000 of net income will qualify you for some of that credit.
And do you qualify for the Canada Workers Benefit on top of the Trillium benefit?
They're separate credits, so you can get them both. The Canada Workers Benefit will come off of your taxes, and the Trillium is a separate credit that you get monthly installments. So they come in different pots.
Going back to the body, I just have to do a little plug. I just found out about the Artist Health Center.
Yeah, it's great.
It's incredible.
Yeah.
And also if you qualify for their low income, there's a subsidy grant where 75% of massage, I think there's chiropractic, like all of those kind of additional things.
Awesome.
And then you only have a 25% copay.
They're awesome there. They send people to me for some. I don't know. They know me, but they're great. If you need that, it's at Toronto Western, right?
Yes.
Yeah.
Toronto Western,
Yeah.
third
Really,
floor.
really, really good resources for people who need that. Thank you.
I had a sort of a larger arching question that doesn't deal with this
Yeah.
kind of stuff.
I think we've kind of worn out all of our.
It's around the subject of creating a not-for-profit or a charitable organization in terms of. So I run a concert series. I have a musical ensemble that I run, and we don't make a lot of money off of this thing. right? It's basically any money that we do make. Sorry, any money that we do make, I try and split it up to the artists. I think, you know, I start off paying them basically union scale, and I'm hoping to pay them more. Is it beneficial for me to declare or to try and get this thing declared as a not-for-profit or a charitable organization, as opposed to just running it as a business and just and taking a loss every single year?
I mean, charities and nonprofits have a whole different tax system. You need to have audited financial statements a lot of the time, so your accounting becomes a bit more fussy. Generally, you need to have a bookkeeper on staff, and an audit can cost anywhere from $2,000 to $5,000 with somebody who will do an audited financial statement for your board. It really depends on what your goal is. If you need funding and you want to get donations, and you want people to give you donations and you want to incentivize that by giving them a charitable receipt, then being a charity is a great thing. Depends on how your long-term goals are. You know what I mean?
Well, I mean, the short-term goals at this point, in terms of this context, is to get out of the crosshairs of the CRA for losing money on.
But you don't have to claim a loss. Like you're not required to claim the loss. You can claim less than the loss and get the working income tax benefit credit or the Canada Workers. Like you don't have to declare a loss. Okay. You can elect to not claim every expense, which is where those things like your clothing and your food, you can chuck them because they're not great.
Right.
You don't have to declare a loss. That's up to you. You have to declare the income. You don't have to declare the expense.
Right. Okay.
Yeah. You had a question, yeah.
Is there a percentage, locked percentage of what you would pay for the internet that you would claim for your business?
No. You use your comfort zone, whatever you feel is most reasonable. It's that term of applying things that are reasonable. Apply a sense of reasonableness to your expenses. Hello. Oh, in the back, Rob.
I was just wondering, with regards to filing as common law, is there a time when it doesn't make sense, or basically you should always do it that way?
The rule is that once you've been living together for a year, you are common law, and that the rule is you got to file as common law from that year. That's it. You don't get to pick and choose.
You don't have a choice. Okay,
you don't have a choice. People don't always want to. That's sort of between the couple. I don't enforce that, but the rule is a year. If you have a kid, it's less than a year. Like if you have a kid, then it becomes the day you have the kid.
Okay, great. Thank you. I do have another one.
Yeah.
Not related to that. With regards to making a large acquisition, let's say you're going to buy a $3,000 guitar, is it always beneficial to try and finance it and write it off over the course of 3 years?
Well, you have to write off a $3,000 guitar over years because of the asset value of it. So you're going to be depreciating it and writing it off over the course of a number of years regardless. So it's about how you finance it. If you can't afford to finance it, like if you were to lease it, you'd write off the lease payments as opposed to depreciate it. And that could be more financially advantageous than buying it because you get the chunk of lease every year. But it could be that it's sort of 6 of one, half dozen of the other, depending on how much it costs and your leasing payment structure. But basically, you can't write off a $3,000 guitar in one go. You won't be able to. Hi. Oh, back there and then back here.
So you were talking about teaching back earlier in this conversation.
Yeah.
And you talked about some type of credit or something. So can you just maybe, I teach music as well, but I also take vocal coaching for myself as a performer. Mm-hmm. So can you talk a little bit about how that works in terms of like credits and write-offs and everything?
Oh, there's no credit for being a teacher. I think the part I was talking about was that teaching music is an exempt supply for HST purposes. You don't have to get an HST number. Is that what?
I'm not quite sure.
Okay.
I know you use the word exempt.
Yeah, so teaching music means that you don't have to get an HST number for teaching income. So you don't have to charge HST on teaching income. You wouldn't on anything else. So teaching music is an exempt supply. The expenses are going to be the same as anything here. So we had classroom supplies as an option. But if you teach music, then the supplies you're teaching are a write-off. The income is not exempt, but it's exempt from collecting HST. Makes sense? And then we had a question there.
So if you had a nonprofit organization, you wouldn't file that with your taxes. It would be
Separate organization, yeah. So this is just for personal sole proprietors and just general citizens. It's not for any kind of a official, it's not for an official business. We're also proprietors as a freelancer, but we don't have a corporate business structure or a nonprofit structure. That's a required, it's a different return. So nonprofits and charities have a whole separate return. Corporations have a whole separate return. Trusts have a different return. So we're just filing a T1, which is just a personal return. Nonprofits have a T30, 10. It's just, yeah. Felipe.
You just touched on a little bit of technical jargon that I think is
love
worth
technical
looking
jargon.
into. So you mentioned sole proprietorship.
Yeah.
So I have what I think is a sole proprietorship, like a master business license of the business, but I know that there's another sort of category, which would be corporation, I think.
Yeah.
So if you could please talk about that a little bit. When does it make sense to not have a sole proprietorship and instead have a corporation?
It's a good question.
So on and so forth.
And we're going to probably sort of wrap it up with that. We are sole proprietors if we run a small business. We just become, you don't have to get a master business license, you don't have to register, you can just be, I'm a sole proprietor, I have a business, I'm running an income statement on my return, I got a business. I incorporate you incorporate for two reasons, one of which is that I want to save myself from liability. So if I have a job where somebody could sue me and I could lose my home, I would incorporate to put myself at an arm's length from my business, so that if I was if I was like a fitness instructor, I'd probably incorporate to keep people from suing me if I break them. So they would sue the corporation, and you get to keep your house. So that's reason one. Reason two is that I'm making so much money and I can't possibly spend it all, which is where performers can come into play. So corporate tax rate, it just got lowered to like 12.8%. It's like 15.5%, but you get the first $500,000 are basically exempt. So you pay very little tax as a corporation, which is the main problem with first world nations, is that corporations pay almost no tax. We pay way more tax. So sole proprietor, an individual, pays at the start 20% tax. Corporations pay 13% tax. So people incorporate to save the money from paying at a higher tax rate. So if you were to become a corporation, you'd say like my company of Joe Schmo, you pay Joe Schmo pays me. So I would pull money out of the corporation based on what I need just to live off of. So the corporation gets all the money and pays the tax at the lower tax rate. But whatever I pull out of my company to sort of pay my mortgage or my groceries, I pay at the personal rate of 20+%. So the more money you leave in the corporation, the less tax you pay, because whenever you pull it out for personal use, you pay it at the regular personal rate. So most people who have a corporation will put themselves on the payroll, and the corporation will issue them a T4. So my Joe Schmo company puts me on a T4. They pay me regular pay every 2 weeks. They pay my CPP and my EI and my tax, and I have a T4 at the end of the year. So my personal taxes are kind of dealt with. My corporation still has to deal with the corporate taxes, but they're paying almost no tax as opposed to me as a person. So the idea for a corporation is that you keep everything you can in the corporation and put only what you need to get by for basics like clothing and childcare and housing and vacations and medical. So the corporation pays for your phone bill and pays for your costumes and your travel and your admissions. The corporation pays for your business, and then pays you for a personal percentage if you need to pull it out for personal, so for paying your rent or stuff like that.
So if it's as we discussed earlier, if let's say 30 grand is the limit for when you have to get an HST,
right?
When would you advise somebody to incorporate instead of remaining as sole proprietor?
It's the idea of I'm making more money than I can spend. So we had clients at Artbooks for a long time who made $250,000, but he never incorporated because he spent $250,000. He didn't need to incorporate because whatever he brought in, he went out. He didn't pay a lot of tax because he was spending it all. But I have a friend who's a lawyer, she's not incorporated because she pulled all of the money out of her she would pull it all out to pay for her house. So she's not incorporated because even though she makes like $1 million, she spends it all. No corporation because she's going to pay tax on it regardless. So if you make a lot of money and you don't need to spend it, you would incorporate. So if you make 60 grand and you only spend 10, you could incorporate, but you're looking at the tax brackets, and brackets are basically every $45,000. So the first bracket, if you're making 60, you're paying very little tax. If you're making 100 and you're spending 10, you're going to pay a lot less tax on that 90 in corporation than you are as a sole proprietor. So basically, it's like, what are you spending? If you make $100,000 and you spend $80,000, don't incorporate. There's no point. You're going to be paying tax on 20 grand. That's the lowest tax bracket. If you're making $100,000 and spending and spending 90, personally, you're going to be paying it at the highest bracket anyway because you're going to be pulling it into your business, into your personal. So ideally, it's basically like if I make too much money that I can spend. If I don't need to spend it and it can just sit idly in a bank account and collect dust, then incorporate. If I'm not going to spend it. Yes.
Sorry, there's one more here from online. It's been waiting for a while.
Oh, okay.
This is Daniel, and this touches on something you've already brought up.
Sure.
If you make most of your money from teaching in your profession and some money from commissions, etc., do all these claims apply to everything as a whole, including T4As from music school?
Yeah, basically, you are probably going to just run one business. You could divide it into, you could have two businesses being teaching and other stuff, but that's more paperwork. So you're running one business. So all the freelance, the teaching, and if it's all related to one art form, like I'm a musician and I teach music, then it's just one business at the end of the day. I
But
would
what
say.
about, say, a T4 from a university?
Well, T4s
that
go in a
the-
different part of the return. They don't
Right.
they don't live in this realm. They go in a different part of the return entirely.
I think that's probably what a number of us are dealing with here,
Yeah.
with a T4 and then a lot of
Uh-huh.
T4As and T5s.
You can have T4s, T3s, T5s, T4As. Like there's a bazillion T slips, but mostly T4As and T5s live in the business, and T4s go in a different part, and T3s go in. Like they just, if you're doing your taxes yourself, you're going to follow the interview that the software is giving to you, and it's going to put your stuff into the right lines for income. I think we're going to get ready to wrap up because it's almost 3. It's been very long. It's a lot of tax. Tax is very boring. Is there anything that anybody needs? Any final thoughts, or you all good? Overwhelmed? Ready to file your taxes?
Just thank you so much. This has been really invaluable. We really
It's
appreciate
a lot
it.
of information to get in 2 hours. I do encourage you, though, if you have a chance to sit with an accountant who will talk to you and you to get your specific business questions answered, because this is all very general, but everyone's business is different and has different requirements. So if you need to, don't forget to go to see an accountant and write it off, because it's a nice write-off. It's not a bad deal. So thank you so much for being awesome listeners, and to the people on the internet, thank you for being awesome listeners. I have some business cards and free pens. There are free pens if you want a free pen. Come on over and grab one. Otherwise, go out into the nasty weather and good luck with your taxes.